Making real estate fetch.
Hello and welcome to Making Real Estate Fetch. I'm your host, Grace Petro, joined by broker of Ross Real Estate, Tyler Ross. Say hi, Tyler.
Oh, hi, Tyler.
If you're new here, what we do on MREF is break down real estate knowledge to make it accessible for the next generation of homeowners, like myself, and to anyone who needs the wide world of real estate dumbed down a little or a lot. Today is a very special day because we have asked Dave Kalk to come and answer some of my questions about all things lender. You may know Dave from our Mortgage Monday specials, or if you're in the area, he's one of our friendliest and most trusted faces in the community. How are you today, Dave?
I'm great. I'm really thrilled to be here.
Awesome. Well, we're thrilled to have you. We want to thank you for coming on here. Obviously, you've helped us in a lot of our content in the past, and you and Tyler have done a lot of content before even I came on. And you've proven to be like a fountain of knowledge in your field.
Thanks.
Our challenge today is to keep everything super light and easy. So if I feel either of you heading in a direction, saying stuff that an average 20-something wouldn't understand, I will cut you off because that's my job. Okay?
Fair.
All right. That being said, can you tell me what a lender is in layman's terms?
Yeah, so I guess by definition, the State Corporation Commission tells me that I have to put on my business card mortgage loan originator. That is what my title is, technically. And what a mortgage loan originator does is originates loans. And we do that through contacts, referrals. So, for instance, if Tyler has a client, say it's you're a first-time home buyer, and says, I would like for you to help Grace. She's interested in purchasing a house. My job as a mortgage loan originator is to help walk you through the process. And that starts with educating you on what the process is, and then kind of, I like to think of it as a good analogy is a Sherpa. I'm helping her get up the mountain.
Mm-hmm.
I can't carry her by myself, but I got a machete and I'm going to clear the path, and I've been up the mountain enough times to know how to get up there, and I'm going to guide you. And if I do my job correctly, you're going to get up the mountain and go, this wasn't as hard as I thought it was going to be.
Mm-hmm. Okay. Tyler, do you think you could tell me in an agent's terms, why do I need a lender if I'm going to buy a house?
Okay, well, as a first-time home buyer, it's not probable that you have the cash to buy a house outright without getting a mortgage or a loan. So the reason you would need a loan to buy a house is to pay for the balance of the purchase price of the loan, the balance being everything left over after your down payment. So a typical example would be, if you're an easy one for numbers, $100,000 house and you have
Please make it easy. Yeah,
$100,000 house and you have 10% to put down. That's $10,000 down payment, and then you'll need a loan for $90,000. And the way that you would go about getting that loan is speaking to someone like Dave, who is an LO, which is a common expression for loan officer.
So you're like the middleman when you like if I need that money, I don't just go to the bank and I say like, hey, I need $90,000. I say, I'm going to have my friend Dave ask you for $90,000 for me.
Well, make no mistake about it, banks have loan officers too. So if you went to your bank and you said, hey, I need a loan, I want to buy a house, they would put you in front of one of their loan officers at the bank.
Okay.
What's different with me is that my company, we are what's called a direct lender. And as a direct lender, it means that our loans get sold directly to Fannie Mae, Freddie Mac, Ginnie Mae, and then roughly 20 some other banks. So if your particular situation is a little bit unique, we have a whole variety of different banks buying our loans that one might allow for something that another bank doesn't allow. Okay. So you've got a bigger pond with more alternatives, and subsequently, typically a little bit better pricing. Because if you go to a bank, your rate is whatever that bank's rate is.
There's no,
that's it. But you can certainly accomplish the same thing at your bank.
And so if I can put that another way, I
Yeah.
want you to correct me if I'm wrong, is that you go to the bank, you get a loan from that bank. You go to Dave, Dave can generate pricing for a loan from a bunch of different banks. So you are kind of, does your company fund the loan and then you sell the loan to another company
Yeah.
and your company gets reimbursed and you do that over
We
and
fund it
over
at closing and then the loan is sold. And what's interesting about that, Grace, is that if, with our 21 different banks, if I lock your rate up front, we pre-approved you, you found the house, Tyler says, we're ratified, we got a contract, and I lock the rate with, let's just say, US Bank, because they're one of many. When we go to closing, we're going to fund the loan, and then US Bank may or may not retain the servicing rights.
Okay.
So you may end up paying your mortgage to BSI Financial in Texas, which is where I pay my
that's
mortgage,
where my mortgage
right?
is.
At BSI. So just because we lock the loan with a particular bank that's on our list doesn't mean that they keep the loan. They may sell the servicing rights. This is pretty common,
Okay.
and it's just called the secondary market.
Okay.
That's a little bit complicated.
It
You don't
is.
need to worry
It is.
about that because
Okay.
it doesn't affect you.
Cool.
Your payment is established up front,
Okay.
and when you go to closing, it is what it is, and it doesn't matter who ends up ultimately possessing that mortgage.
Uh-huh.
Nothing changes with yours, so you don't even need to know all that stuff.
Okay. Thank you. Because it
Yep.
was leaving me.
Well, I'll simplify.
Simplify.
I lend you as a bank $90,000 to buy a house.
Thank you.
I no longer have that $90,000. You have it. But I have a note that says you owe me $90,000.
Sure.
I can sell that note to Dave. Now, instead of you owing me $90,000,
I owe
you owe
Dave
him
$90,000.
$90,000. Yeah. And that's what banks will do. They will sell a loan to another bank. So now you owe that bank the money instead of the original bank you borrowed the money from.
That's stressful.
You look confused.
But it's
Well,
not, it's not necessarily practically important to the borrower because your payment's the same. It's just who's the check getting written to.
Yeah, I don't understand banks, but that's a different episode.
Yeah.
Okay, can you guys tell me? I know what interest is, obviously. I have a car that I'm paying off. I have a
Right.
credit card. You know what I mean? Can you tell me how does that affect me in a house payment? Where do you come into interest? X, Y, and Z.
Okay, that's a simple one. So, in my videos that I do, that you've seen some of my videos, and Tyler gets my market update, I reference the yield on the 10-year Treasury note on a regular basis. Why? Because banks traditionally set their 30-year mortgage rates based off of what the yield on the 10-year Treasury note is doing at any given time.
Okay.
The spread, or the difference between the rate that they charge the consumer for the mortgage and the yield on the 10-year Treasury, is called the spread.
Okay.
That spread has traditionally, over the last several decades, been about 1.75%. So, in other words, if the yield on the 10-year Treasury note was 3%, you would expect 30-year mortgage rates at most banks to be somewhere in the neighborhood of 4.75%, right?
Yes.
1.75% spread over and above the yield on the 10-year Treasury note.
Okay.
After COVID, we had something of an economic meltdown, if you will,
Oh yeah.
and banks perceived much more risk in the market.
Okay.
As a result, they increased their spread, and they haven't been so generous with passing on a spread of only 1.75% to clients looking for a 30-year mortgage. That spread has jumped up to over 3%. So now, instead of the yield on the 30-year Treasury closed Friday at 3.95, for instance. So instead of 30-year mortgage rates that all the banks kind of huddle up at 1.75% over 3.95, they're more like 3% over
Okay.
3.95, which is 6.95. So that's where they are. That spread is banks' way of mitigating or building in a little buffer for the unknown risk that is perceived in the economy, and of course, not to mention, which we're not going to do here, get into geopolitics. So when banks perceive more risk in the environment, you can see and expect to see that spread get
Higher.
wider.
Okay. So is this if you were to get, are there different term limits for mortgages, like 30
Yep.
years, 50 years?
30
years?
year is the most typical.
Mm-hmm.
And then there are 15-year mortgages, and there are even 40-year mortgages. I don't think I've ever done one.
And that changes your rate like significantly?
Well, what's funny is there used to be, and if you've ever heard of Dave Ramsey, financial guru, I disagree with Dave Ramsey on one of the things that he says is that you should have a 15-year mortgage. Well, I disagree with him. And the reason is because none of these loans have prepayment penalties anymore, number
Okay.
one. Number two, the difference between a 15-year mortgage interest rate and a 30-year has really shrunk.
Okay.
There used to be a huge difference in going 15-year versus 30-year, and that difference has shrunk to where there's not a huge difference in interest rate. Plus, the payment is much larger on a 15-year mortgage because you're amortizing the full payment over 15 years instead of 30. That larger payment can be cost prohibitive for some people, especially first-time home buyers.
Right.
My thought, just reaching back to my financial advisory background, is why not have a lower payment, but if you wish to pay it off sooner, make extra payments and pay it off quicker. My first house, for instance, I was a young guy, 27 years old. I had two roommates. I collected their rent and I threw it at the principal of my mortgage, not realizing, of course, what I was doing, but what I actually did was created a 15-year payoff of a 30-year mortgage because I was accelerating principal payments.
Right.
So my house built up equity so much faster that I literally had it paid off in 15 years.
And you're only paying interest on the principal that's outstanding. So as you pay down the actual mortgage amount, your interest payments get reduced over time. So you
Like
pay
a
less
car?
interest. Over,
Yes.
Yeah, if you paid off half your car right now, you'd have half as much interest. Well, that math is
But in that same
imperfect,
note,
but-
like, can they screw you over and say, like, actually, you're going to pay more now because you've been late on these payments?
Well, so one thing for clarification, the difference with the car payment, that's an installment loan.
Okay.
So if in Tyler's example, you went and paid off half of your car loan balance, your payment would remain the same.
Okay.
So when we're advising people, one of the things that we never advise is to pay off an installment loan, to pay down an installment loan unless they paid off all of their credit card debt, which is revolving loans. Because with a credit card, as you know, the lower the balance, the lower the payment.
Right.
Not so with a car loan. You could have 5 payments left on your car loan. The payment's the same as it was when you took it out.
Right. Right.
So there's no, unless you can pay it off completely, there's no huge advantage to paying down the balance on a car loan unless you have no other debt.
Right.
If you have credit card debt, you definitely want to pay that off first before you address.
And we're going to talk
Okay.
all things credit.
Yeah.
Don't worry, because that's a big one. Tyler, do I need homeowners insurance?
Do you need homeowners insurance? Absolutely. Anything that you have in your house that, the house itself and the contents of your house, if it were to be damaged in a catastrophic way. For example, my dad's house went up in flames a few years ago and all of his stuff was ruined. The house was burned to the ground. If not for homeowners insurance, he would have been left holding that bag. He would have had a whatever mortgage on a house that doesn't exist anymore that's ruined. So insurance is something you would absolutely want to have on your house. And your mortgage company is going to require you.
And
to
it
have
is a
insurance.
requirement.
That's what I
If
was
you're
gonna
getting a
ask.
loan, you've got to have it in place the day
So it's
you
not
go
like
to
a
close.
car where like in some, because I didn't have car insurance till I moved here, but I didn't know that you had to have it here. Some states you don't. Some states it's not illegal.
It's
So-
a requirement because the house is the collateral for the loan. So
Okay.
the reason the bank is going to require it is because that's their collateral.
It's their
If that
money.
collateral goes up in flames,
Right.
what's left? A pile of ash.
Right.
So you have a $500,000 house with a $400,000 mortgage and it catches on fire. Now the house is worth $120,000 and the bank, you owe the bank $400,000 with no way to pay it back because the value is in the sale of your house to pay off that $400,000. So insurance reimburses you for the damage to your house so that you can pay your mortgage off or replace the house so that the bank has collateral against your loan.
Where do they get the money?
The insurance company,
Yeah.
it's all pooled together. All three of us are paying insurance and maybe nothing happens to our house. So they
Oh, it's
get
what you
all
pay
the
every
money.
month.
Yeah.
Yeah. Okay. Okay. Okay.
Exactly.
Okay. It's all coming together.
Yeah.
It's all coming together. PMI, PITI. What are these things?
PMI is private mortgage insurance,
Okay.
and it is a requirement on loans in which the borrower is not putting at least 20% down. And think of it this way, the bank, you may have really good credit and you may not have much debt. But if you're only able to put up, in Tyler's example, 10%, most banks aren't going to have the feeling that you've got quite enough skin in the game.
Right.
And so to protect themselves, they will require mortgage insurance
Okay.
as part of the payment, and it's a way to protect them,
Them, yeah.
in the event that you default on the loan.
What does default on a loan mean? Don't
Means
pay
you
it?
just can't pay it anymore.
Okay. 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 PITI. Are they related?
Principal, interest, taxes, insurance.
Okay.
PITI would be if you're trying to get an idea, which, and this would be part of the process that I would be walking you through in getting you pre-qualified to buy a house and start shopping with Tyler. One of the things you would want to know is, hey Dave, if Tyler's going to show me some $350,000 houses, if we're going to go look, what would I expect my payment to look like?
Right.
That payment is going to be composed of principal, interest, taxes, and insurance, and possibly an HOA fee if the house you're
Right.
buying happens to be has an HOA.
So the PITI is what like the payment's comprised of, and the
Right.
PMI
Those
is
are the
specific,
components of the monthly mortgage payment.
and the PMI is a specific thing that you need if you don't put 20% down.
Correct.
Okay. We're doing great. And is that universal, like for every lender,
Well,
everyone?
so
everyone?
yes. So if, for example, veterans have the ability to get VA funding, and a VA doesn't charge mortgage insurance. So it's kind of interesting. That's a benefit that our veterans get.
Okay.
The VA loan is pretty nice. Our veterans can, if they qualify and are eligible, they can get a VA loan with 100% financing, put no money down, and not even have mortgage insurance. However, they pay what's called a VA funding fee.
Okay.
And so that funding fee, which typically is in the neighborhood, depending on how many times they've used their eligibility, 2.15%. So 2.15% of the loan amount, the amount being borrowed, gets added to that loan and carved out, and that money goes to the VA, and they keep that fund there, and so that fund is kind of their slush fund, if you will, for potential defaults
Okay.
versus charging you monthly mortgage insurance.
Okay. Okay.
Does that make sense?
It's getting there.
Yeah.
That's why you talk to someone like Dave, because there's an overwhelming amount of different ways to fund a loan, to get a loan, lots of different products, lots of different banks, lots of different programs. And someone like Dave is going to be an expert in helping a buyer figure out which one is best for them based on their stated goals.
I want to dovetail off of something Tyler just said, because this is really important. So since we're talking about private mortgage insurance, one of the things that is extremely helpful with a knowledgeable loan officer is that there may be a situation. I'll use an anecdote, okay, an example that actually happened with one of my borrowers. A few years ago, I had a borrower that was building a house.
Okay.
She expected that when she went to sell her condo, she was going to have X amount of money that would enable her to put 20% down and have no mortgage insurance. What ended up happening was the market kind of turned and she didn't get as much as she thought she was going to get for that condo or that townhouse. I think it was a townhouse that she had. She didn't make as much money.
Okay.
So she called me crying, "Oh my God, I can't put 20% down. My townhouse sold for so much less. What am I going to do?" And I said, "Well, you'll have mortgage insurance. Let's see what it costs." So we got some quotes and we looked at having mortgage insurance as part of her monthly payment, but also I recognized that she had really good credit. Her credit scores were really high. And she had enough to put 17% down. She just didn't have enough to put 20% down.
Okay.
So I looked at what's called single premium mortgage insurance, where rather than having it as part of your monthly payment, you pay it up front at closing and never have it as part of your monthly payment. Well, because her credit scores were so high and she was so well qualified, when we got a quote for the single premium, it was so low that I want to say it was like less than 1% of the loan amount. So she was actually better off getting that single premium mortgage insurance. Her payment was lower. And so she was able to keep, rather than putting 20% down, like she had 17%. So that 3%, this was a big house and a big mortgage, that equated to a lot of money. So she was able to keep more money in her pocket and avoid having mortgage insurance as part of her payment. So it had a happy ending, but it takes the knowledge of a mortgage professional to know these options and be able to weigh them against each other and see what might be most advantageous to your personal financial situation. Because if you don't have the extra money to pay for single premium at closing, it's a moot point. So it's vital that you and your loan officer share all this information and can make these determinations. Does that make sense?
So, some of it, and I don't need to worry about it just yet. But the meat and potatoes of it makes sense. And I wanted to ask you before I forget, because we have two little questions coming up.
Yeah.
But before that, just very quickly, I know, like, to meet with a real estate agent, that kind of timeline. Is it the same for a lender? Do I want to meet with my lender before I meet with my real estate agent?
Yes.
How soon do I want to get in touch with you?
Because Tyler needs to know before he puts you in his car and starts driving you all over the place
what you're looking for.
He knows you're going to be able to get a loan for.
Okay.
It should not be some random thing. He should have a very clear picture. Otherwise, he's wasting his time and he's wasting your time if he's showing you houses that you're not even going to be able to get a loan for.
And agents have lenders that they work with, that, like, routinely?
Yes, having a good stable of resources across the board, whether it's home inspectors or insurance agents or loan officers, is an expectation of every real estate agent you would ever meet or connect with. And Dave has been a fixture in my, black book of resources, whether it's directly with buyers or just questions that I have about things that I'm coming up with. Even if my client is working with another loan officer, Dave has always been available as a resource to me. So, he's someone that I use frequently.
Okay.
Or I encourage others to use frequently.
As do I.
And I'm appreciative of that.
Well, I'm appreciative that you're listening to this. Tyler, how do taxes affect my payment?
That's probably more of a Dave question, but it factors into the PITI that you were talking about. The bigger the house.
That's the T.
Yes, that's the T in
Okay.
the PITI. So your house is going to have an assessment of what it's worth based on what the county thinks, whatever jurisdiction that you are in, a county or a town. And that assessment is factored in with the tax rate that that county charges. So the higher the assessment, the higher the value of the house, the more taxes you're going to pay. So
And is that like private property?
it is like private property.
Okay.
It basically is that. There's personal property, like your cars,
Yeah.
computers, things like that, and then you've got your property taxes, which is your real estate.
When do you pay that?
And Grace, let me give you a good reason why that comes into play. So let's say, for the sake of argument, that we determine that based on Fauquier County's tax rate, that Tyler is going to start showing you houses in Fauquier County that are $400,000. Okay. There's an expectation of what the estimated taxes will be on a $400,000 property in Fauquier County based on Fauquier County's tax rate. And you're looking in Fauquier County because your family lives here or whatever the
Right.
reason. So you start here. But as you go out and you look with Tyler, you just can't seem to find anything that fits the bill. And you're like, man, I'm getting kind of frustrated.
Right.
And so you discover that if you're willing to go one county over to Culpeper, their tax rate at, what is it now? Like 52 cents per $100 of value is significantly less than Fauquier County's. So the exact same $400,000 house, just because it's in Culpeper County, the tax piece of the PITI is so much lower.
Right.
So your payment is subsequently lower, which means you might be able to buy a $500,000 house
Right.
or a $475,000 house in another county
Right.
and have the payment be the same as if it was here. So your buying power increases by virtue of the county tax rate just being significantly lower. And as you would expect, you get closer to DC, that tax rate gets higher.
And are you getting taxed monthly? Like, is this a part
It's
of your
part
like
of your
mortgage
monthly
and
mortgage
stuff?
payment.
Okay.
Yeah, in Fauquier County, though, if you have a loan that does not include your taxes and insurance, mine includes PITI, some just include PI. You would be billed every 6 months. So I think it's June 15th and December 15th are when property taxes get paid.
Okay.
And
In
the
Fauquier County.
in Fauquier
Some
County.
counties, it's just at the end of the year. It's a county by county.
Is
Yeah.
private property just once? Or what is it called?
Real estate taxes.
No, the other one. The one
Personal property?
Yeah.
I think that's annual. I
Okay,
feel
good.
it may be
Like a
twice.
car.
Yeah.
Yeah.
That's-
It's also new to me.
Yeah,
That
so
might be
just
once a
making
year.
sure it's once
Is
a
it
year.
once a year? Yeah.
Now we're gonna close with pre-approval stuff, credit, all that good stuff. Where should I be? How should I get there before I am seeking to buy a house? And do you help me with that whole process,
Yes.
or do I start it on my own?
Yeah, okay, simple. You've determined that this is your guy, he's gonna help you buy a house. Tyler says you need to get with Dave first, get pre-qualified, we need to know what range we can start shopping in.
Okay.
So the first thing I'm gonna do is I'm gonna have you fill out a loan application. It's gonna include name, address, social security number, date of birth, where you work, what you make, and then I'm gonna pull what's called a FICO Classic credit report. Now, what's different about that credit report is most of us get these things in our email all the time about check your credit score. You know, Credit Karma's out there, and there's a lot of credit services. 9 times out of 10, the credit scores that they are providing are using a model called Vantage 3.0, which is what banks typically use to approve people for credit cards. Okay? Buying a mortgage is a lot more serious than getting a $1,000 credit card payment. So the credit report that we have to use, FICO Classic, is much more detailed.
Okay.
It's going to show the first time you were late coming home on a date and your dad got mad. No, I'm just kidding.
It's stressful.
But it's going to be very, very, very detailed. And we
Okay.
have to use that.
So if my
Credit
credit's
report.
already bad, hypothetically, you
Yeah.
know what I mean? And then I do one of your fancy credit score
Right.
things. Am I expecting it to be worse?
Probably.
Okay.
But the difference is, once I have the FICO Classic credit score, we have credit simulators
Yeah.
that will show us specifically what to advise
You can
you
see
to
exactly
do
what to
to
do,
get
yeah.
your scores up. So for instance, let's just hypothetically say we want your credit score, and it's the middle score that's the one that counts, because there's 3 credit bureaus. And
Okay.
Fannie Mae and Freddie Mac tell us that we have to use the middle one. Not
Okay.
the high one, not the low one, the one in the middle.
Okay.
So let's just say your middle score is a 598, hope it's not, and we need you to get to a 640. And I say a 640 because at a 640 mid score, unless you got a whole lot of other stuff going on, most of our banks are gonna not have a problem with a 640 middle score, okay?
What's like typical credit that you see? Like, what do you think is like the average? Because I know like what good credit is, but
Oh, maybe high 600s to low 700s, probably in that range, somewhere between 675 and 725. But I'm doing loans at 620. You know, we can do 620. So let's go back to our example and just say your middle score is a 598 and we want you at a 640. I can run a credit simulator that will tell us exactly what you need to pay off and what you need to do to get that middle score up to a 640. And it will tell us the probability of you getting that 640 if you do the things that they tell you to do.
and like in an amount of time.
Well, the amount of time will be generally determined by how much cash you have on hand, because a lot of times the quick score bump will come from somebody that's got a lot of credit card debt. Like they have some credit cards that are maxed out. That's an easy fix. You
Right.
pay those down and your scores skyrocket in a hurry.
Okay.
So that's the easiest fix. If there are no credit cards, then it can take longer. So
Right.
that the time horizon to get those scores up is much longer when there aren't revolving lines of credit that we can address that can quickly solve the problem.
If there's anything to learn from the conversations that Dave and I have had and put out there, it's for anyone who's thinking about buying a house to get started in the process really early. Because if you find out your credit score is lower than it should be in order to qualify for the loan that you want so that you can buy that house, someone like Dave can help you through these simulations to rehabilitate your credit score. And that doesn't necessarily happen overnight. It's a
Right.
process. So we'll say over and over again, if you're thinking about buying a house anytime in the future, now is the time to assess your standing and your ability to buy a house. So you find out all of these things as soon as possible so that if there are problems,
You can
you
fix
can
them.
address
Yeah.
them.
Thank you for that, Tyler. That said, I've had situations where we were able to get someone's score up in 2 weeks.
Yeah.
It depends on what it is that's depressing the scores.
Yeah.
And the reason that Tyler is so right about getting with a lender as soon as possible is you don't know, right?
Yeah.
So if we don't know, we can't fix something that we don't know exists. So yes, I've had situations where I could get that credit score bump in 2 weeks, but I've had situations where you scratch your head and go, I'm sorry, this is going to take at least 6 months
Right.
to get this going.
Right.
You need to know that, you know, so you can plan accordingly, because again, the worst thing, and I don't want to see it, and Tyler sure doesn't want to see it, is you think you're okay,
Right.
And you go out and you look at houses and you find your friggin' dream house. And you were so excited, and Tyler's excited, and we find out we can't fix your credit
Yeah.
in 45 days, that it's a 6-month process. Well, it would have been nice if you knew that before
Going into it.
you had your heart set on this dream home.
Okay.
There's
Yeah.
there's a flip side to that also. A lot of people look at that dream home and think there's no way I can qualify for that because they've determined on their own that their borrowing power isn't good enough, their credit's not good enough, they'll never
Right.
buy that house. And so without talking to someone like Dave to validate or invalidate that feeling, maybe they go buy a truck instead, maybe they go on vacation instead, and they make things worse on themselves and take themselves further away from
From the
buying
goal,
a house.
yeah.
So a lot of people don't even enter the market. A lot of people just go, I would be a home buyer, but I can't, and they decide that for themselves when they shouldn't. They should talk to an expert, someone like Dave, someone like me, someone that can connect them to people to help them genuinely assess if they can buy the house and why they can't now if they can't. And if they have 5% down and they decide that that's not enough to put down on a house and they spend it, they rent a helicopter for the weekend or buy a fishing boat or something, they put themselves in worse position over time. So before anyone makes any judgments about their ability to buy a house, they should absolutely talk to a loan officer to see what's between them and that goal.
Okay, good.
That makes sense?
Yes. I think we've come a very long way today. That being said, do you want to plug socials and where we can find you, more of your advice, your expertise?
So right now I'm trying to put market updates out on Facebook. Trying to do those every Friday. I have an email real estate and mortgage and real estate market update that I'm sending. I've got a distribution list. I'm welcome to add anyone to that distribution list. And also I'm on Facebook, both. I've got a personal Facebook page, which I use mostly for business, and I have a business Facebook page.
Okay.
And I am, as Tyler knows, I am available 7 days a week. You don't have a problem tracking me down.
Yeah, and I can attest to that. And I find great value in your market updates. You're from the trenches email, which I think is just a great title for what it is. To be added to that list, should someone email you and ask?
Just say, hey, can you add me to this
your,
list?
What's your email address?
dcouk@ihmcloans.com.
And I'll put all your socials in the caption and stuff as well. Tyler, can I guess yours?
I'll give you one guess.
I know what they are.
I know.
Okay, so your Instagram, @TylerJamesRossVA. Facebook, you just click the @TylerRoss. And then sometimes it doesn't work, but it's the one that says Ross Real Estate on the Hootsuite. Other than that, I don't know. And then those are the big ones.
Yeah,
Do you
Ross
want to talk
Real
about your
Estate
email?
VA. TylerJamesRoss@gmail is my email address. If anybody has any questions, I'm
Right.
happy to field them.
And DMing you is also obviously an option, or DMing Ross Real Estate for any questions or episodes or anything. We want to thank you for being a part of Making Real Estate Fetch and helping to make real estate knowledge more accessible for the next generation. Do you have anything to say before we sign off?
No, just that my number one piece of advice has been and continues to be get involved in the process well before you're ready to get in his car and start driving around.
Roger.
Because you give me time to fix anything that you don't know about or that we don't know about. The worst thing is for you to find your dream home, go out with him, call me, and we haven't even gotten you pre-qualified, and we find out you're not. We just can't
Right.
get you financing for that.
Right.
I don't ever want to see that happen to anybody.
We won't let that happen. We won't let that happen. Tyler, anything?
To paraphrase a character that Sam Jackson played in a movie, I can't
Jesus
remember.
I should have known.
Don't make any assumptions because it makes an ass out of you an option. So don't make any assumptions about your ability to buy a house. Make sure that you've talked to an expert, and then you'll know for sure.
All right, I'm calling it because I don't trust either of you anymore. So we're going to close. We will see you all 2 Wednesdays from now with more Fetch Inside tips. We're all going to say bye on 3. Ready? 1, 2, 3.
Bye.